Hello and welcome back to the last session in the secondary marketing. Of course, the last lecture in US mortgage course itself. So the name of the lecture is type of the sales in the secondary marketing. So selling closed loans to the investor generates the funds to continue making the loans. Ideally, the mortgage banker accomplishes mortgage originations and the sales at a profit or breaks even. Some loan sales, however, will cause the mortgage banker to incur a loss. Such losses are acceptable as long as they fall within the company's established guidelines and are minimal. Lenders, government-sponsored agencies, and the investors exchange mortgages in the secondary mortgage market in the following forms: whole loans, participation, and the mortgage-backed securities. Whole loan sales. A whole loan is the sale of 100% unsecured of an unsecured loan or unsecured pools of loans. Investors, as the owners, hold the actual mortgage and promissory note for each loan until maturity. Whole loans are sold either with reserves or without the recourse. If a loan is sold with a recourse and it goes into the default, the seller may be required to repurchase the loans. Most loans today are sold without recourse, which means that the investor assumes all the liability for the losses due to default. Investing in whole loans has its drawbacks. Whole loan sales involve a lengthy document gathering process because to ensure that their investment is sound, purchasers of the whole loans require the seller to provide a certain documentation about the mortgage, such as the note and the copies of the mortgage or recorded mortgage. The need and the underwriting documentation requirements vary from investor to investor. Evaluating the whole loans as investments is difficult because each investment is unique. Okay, so what is participation sales? A participation sale is a sale of a partial interest in a loan or pool of loans with the originating lenders retaining a percentage interest. Participation sales usually involve conventional loans with a 90/10 investor to lender ownership split. This arrangement speeds the sale because few loan documents are transferred to the purchasing investor. The lender gains leverage from the 10% interest it retains, and the investor is assured of loan quality since the lender remains a party to the loan after the sale. Alright, mortgage-backed security sales, MBS sales. The debt instrument formed by securitizing a pool of similar type mortgages is called a mortgage-backed security or MBS. The pooled mortgages have individual interest rates limited to a stated range or the spread and provide an investment return through the regular payment of the principal and the interest. The security instrument instead represents an undivided interest in a pool of mortgages. An investor in a mortgage-backed security holds a security interest in a mortgage pool instead of holding an actual mortgage and the promissory note. Ownership is evidenced by certificate. Mortgage-backed securities are of the following different types. First one is pass-through securities. These are the securities in which the principal, interest, and prepayments are paid directly to the investors of the security. A grantor trust holds the mortgage collateral in which the investors own an undivided interest. The payments to investors are linked to timing of the mortgage receipts. When an MBS is sold, the lender or the issuer of the security relinquishes ownership of the mortgage assets. A special type of pass-through, modified pass-through, an agency pass-through that guarantees timely interest payments and principal payments as collected, but no later than a specified time after they are due. The greatest volume of the pass-through securities is issued through the Freddie Mac and the Fannie Mae. Alright, what are the mortgage-backed bonds? The lender or the issuer retains ownership of a mortgage pool using the mortgage as the collateral to issue the bonds. Two types of the bonds which are called as pay-through and the straight bonds. In case of the pay-through bonds, the cash flow from the underlying secures the bond through the cash flows are unrelated. So in case of straight bond, the market value of the underlying mortgage pool secures the straight bond. Due to complex accounting and dual taxation involved, fewer mortgage-backed bonds are issued in comparison to pass-through securities. Special mortgage-backed securities combine features of the pass-throughs and the mortgage-backed bonds to form a hybrid securities. Special MBS appeal to special investor needs, particularly as regards scheduled cash flow payments. Tax and accounting treatment of these securities depend on the features of each security, whether it looks like a pass-through or a mortgage-backed bond. The most common special mortgage-backed securities are, to give an example, one is collateralized mortgage obligations, which are also called as AMOs, or the multi-class pay-through mortgage-backed bonds. Bond classes are characterized by the different maturities and the investor yields. Each bond class or the tranche has a set schedule for distributing cash flows to the investors. Normally, each tranche pays interest regularly, while principal and the prepayments are paid to one class at a time until the class is retired. Z bond or accrued bond final tranche receives no principal or the interest until all the CMO tranches have been retired. CMOs are normally treated as the debt obligations and are taxed twice. Alright, what is real estate mortgage investment conduits, which are also called as REMICs? These are the vehicle for issuing the multi-class mortgage-backed securities. They are similar to CMOs but more flexible. REMICs can be structured as a mortgage-backed bonds or as the pass-throughs. REMICs are considered as a sale of assets rather than a debt obligation, so they have the advantage of single taxation. Investor participation in a REMICs is by regular interest, ownership in the bond class with a defined payment speed, residual interest, ownership in excess mortgage principal received due to accelerated prepayments or over collateralization of the security. Special mortgage-backed securities. What are SMBs? SMBs are the security instruments formed by stripping principal cash flows and interest cash flows to make separate securities. So most prominent SMBs are interest-only IO and principal-only PO. In interest-only IO strips, IO investors receive all the interest cash flows. In principal-only strips, PO investors receive all the principal cash flows. I hope you enjoyed this US mortgage session. This comes to an end of this course. So please go through whatever all the decks attached to each lectures and from each module. So that will help you to understand more on this US mortgage course. US mortgage as a domain. Thank you so much for listening, and I hope you enjoyed this course. I hope you have learned a lot from this course. Please leave your feedback. Please leave if you have any questions, please feel free to post all those questions in the Q&A section. I would be happy to answer all of them. Thank you and have a good one.